Well, hello everybody. Got another minute here before we get going. So I sent out, or I posted some of the this review session, the questions that we're going to be going over. So hopefully you had those to take a look at. We'll go through those. It should take about an hour today, and then with chapter 16, we'll jump into that obviously next week. So it's a week. Our next session will be a week from this Thursday. And then with both of these, I think one challenge you may have kind of noticed already is that there's just a little um, a little things, like little problems. And so you got to kind of figure out, which one we're talking about. And so as we read through these, I think one of the things hopefully you start to figure out is how certain questions are worded, so you know what to look for. So someone asked, we're going to post this recorded lecture. Yes. And so all of them will be on Zoom. Um, Also, what I've been doing now slowly is taking one of the two recordings and putting it on the YouTube channel as well. So that might be a little bit easier to access. So anyway, so between either the Canvas interface or through YouTube, you'll have it. The nice thing about YouTube is it'll be up there indefinitely versus in Canvas, it keeps the recording only for, I think, 30 days or something like that. So like as an example for the final exam, all of these recordings would not be available for the final because of the way Canvas does their storage. So, and so I just have been slowly populating over as well there. So all that to say, let me get this thing going here. Gonna grab the right one. Here we go. Okay, so again, if you have a question, you can either just chime in or put it in the chat. I'll put the chat over here to the right. This time, rather than me typing out from scratch, I actually have everything typed out. I'm just going to highlight it as we go through and change the color of the text. Hopefully, that'll be a little more efficient. The first, three questions or so are meant to be pretty easy, I would say, pretty straightforward. Then we'll get into a few more complicated ones, but not too bad. And so for this first question, on January 1st, 2021, 49er Company issues 6,000 shares of no par common stock and 100 shares of no par preferred stock. And the key is this is called a lump sum sale. And so the total proceeds from the issuance was $55,000. And so we need to figure out how to allocate that 55,000 between the common stock and the preferred stock. And so this is telling us that we can only reliably estimate the fair value of the preferred stock, and we don't have any information about the fair value of the common stock. And so whenever we have a lump sum sale, of course, we're trying to look for the most reliable method to, kind of take that lump sum and allocate it to either the common stock or the preferred stock. And so we use fair values in order to do that. And since we only have the fair value for the preferred stock, what that means is we're going to use the residual or the incremental method, where basically we make an assignment to the preferred stock based on its fair value, and then any remaining amount just goes into the common stock account. Does anybody remember the name of the method if we have a reliable fair value for both the common stock and the preferred stock? Does anybody remember the name of that method? No, that's okay. It's called the proportional method. And so with the proportional method, you kind of have that total fair value, and then you proportionally allocate based on each one's relative fair value. This one's a little easier. The example in the lecture guide actually does the proportional method. Okay, so first off, we do know that the amount of the issuance was $55,000 cash. And in order to do the allocation, we know the fair value of the preferred stock was $101 per share. There were 100 shares. And so we know we need to allocate $10,100 to preferred stock. And what that means is then the remaining amount just gets assigned to common stock as a plug. And there's going to be no additional paid in capital because both the common stock and the preferred stock are no par stock. And so we don't have to worry about par values. If they did have par values, then it'd be a little more complicated, but not too bad. That's meant to be pretty much as easy as it gets. And again, if you have any questions, please stop or put something in the chat. Speak up. Okay, for the next one, so this is a non-cash transaction. So this next problem is a non-cash transaction. So you're going to notice that there's an exchange here of publicly, traded stock and undeveloped land. And so, of course, we have the 100,000 shares of the large publicly traded company's stock, and we have 1,000 acres of the undeveloped land in Colorado. And so we have an estimate for the fair value of the common stock, and we also have a distinct estimate for the value of the land. And so in the chat, or if you want to chime in, that's fine. This, of course, whenever we have a non-cash transaction, we've got to figure out what is the most reliable fair value that we have. And so we use those 3 levels that we introduced in chapter 14, and they get reintroduced here. And so what level fair value is the common stock for this large publicly traded company? What level fair value is that?
Level 1.
Yeah. Yeah. Level 1. Good. Yeah, pretty much everyone's got that right away. Good job. So yeah, it's a level 1 fair value, because with large publicly traded company, I can look to public transactions, and those are identical transactions. If I'm trading a share of stock here in this transaction, that's the same thing as somebody trading a share on the New York Stock Exchange as far as the value of that share. Then what about the fair value of the land? What level fair value is that land? So someone says we have lots of 2s and 3s. So we're going between 2s and 3s. So somebody who's comfortable, why do we think level 3? Somebody who said level 3, if you don't mind. Or I can do it. It's fine.
Is it because it's unique and it's on untapped land, so it would be unique land?
Yeah, and that exactly. I think that was why so exactly that. So whenever you have land, it's going to be either level 2 or level 3. And it really kind of depends on the nature of the land. So if it's, like a house in the suburbs where there's, 300 transactions a year, it's probably a level 2. But when you talk about undeveloped, 1,000 acres of undeveloped land in Colorado, that is not a very common transaction. So I probably would favor level 3. Now, this also gets to the point where in accounting, judgment is part of what you do as an accountant. And so another person could look at this transaction and determine that this land is level 2. But of course, in order to do that, they probably need to be able to point to some other transactions. So all of that to say, there is some judgment. However, there still is a clear winner because the common stock is a level 1. The land is either a level 2 or more likely a level 3. It tells us that the fair value of the common stock, that $5.6 million, is the most reliable way to value this transaction. And so we're going to use the 5.6 million, and that $6 million estimate then becomes irrelevant because it's less reliable. Now on a test, I will say it's going to be clear, which camp we're in. But of course, in practice, sometimes there is some ambiguity and some judgment that needs to take place. All right, all that to say then, when we bring the land onto our account or onto our books, we use the fair value of the common stock in order to do that. So the land gets assigned the 5.6 million. In this case, the common stock does have a par value of $1 per share. So $1 per share times 100,000 shares means that the common stock is going to be credited for 100,000, and then the remaining amount goes into APIC common stock. So the APIC common stock ends up being a plug. So any questions on that one? Okay. So this next one is a preferred stock conversion. So 49er company, they have 10 shares of preferred stock, and they convert those shares on January 1st, 2021. The conversion ratio is 4-to-1. So whenever you see that conversion ratio, that's the number of common shares for every one preferred share. The par value of the preferred stock is $100 and was originally issued for 101. And the par value for the common stock is $1 per share. And let's provide this journal entry. And so we're going to kind of start with the easy part, which is kind of taking off those preferred shares. And so whenever we do a conversion, the preferred shares come off of our books, and the common shares then get issued as part of the transaction. And the easiest piece is the preferred stock account itself, because we know that the par value is $100 per share that's given in the problem, and that there are 10 shares that are converted. So $100 per share times 10 shares is $1,000. The second piece then is the additional paid in capital. Because the original issue price was more than the par value, we would have assigned a $1 per share to each preferred share. So when they're converted, not only does the preferred stock account need to be debited, but any additional paid in capital assigned to those preferred shares also needs to come off. And so that's where we get the additional dollar per share. Again, it's the $101 per share minus the par value of $100 per share. And so that's where the $10 comes in. And the next piece of the transaction is not too bad, but you just have to pay attention a little bit, in that we know the ratio is 4-to-1. And so that means there are going to be 40 common shares that are issued as part of this transaction. Given that the par value is $1 per share, that means we assign $40 to the common stock account. And then finally, the APIC common stock account is a plug for $970. Again, these first three transactions are meant to be pretty straightforward. I would hope that most students on a test would be able to get, any points related to this, get the vast majority, if not all of the points. That would be the goal. Okay, next question. Now we're getting, a little more difficult, not too bad, but a little more. So we have a 49er company. They're repurchasing shares of its own stock, which is $45 per share. And so anytime you see a repurchase of its own stock, we're dealing with Treasury stock. So hopefully you're able to identify that this is a Treasury stock problem. We're given two different dates where they execute a repurchase. One is August 5th, 2020, and the other is October 16th, 2021. And you'll notice that the repurchase price was $7.50 on August 5th, and then 11 on October 16th. We're told that the shares were originally issued for $5 per share. And then we're told that the company reissues 75 shares for $15 per share on January 15th, 2022. And this problem specifically asks only for one journal entry, the January 15th, 2022 journal entry. And we're going to assume that they use the FIFO method. And again, you may or may not recall, but whenever we're dealing with Treasury stock and then we reissue those shares, we have to make an assumption about which shares get reissued first, much like we do with inventory. In this case, they're using a first in, first out method, which basically means that whenever we reissue shares, the first shares to get reissued are the oldest shares, which would be the August 5th, 2020 shares, which were $7.50 per share. Again, that's just kind of setting the tone here. Okay, so now let me get to some of the calculations. The easy calculation, I hope, is the fact that we're reissuing 75 shares for $15, and that means we're going to receive. Oops, wrong one. Sorry about that. Need to go down one more, which means we're going to receive $1,125 cash. And so that part of the journal entry hopefully is fairly straightforward. Now, the rest of it, I think it's important to kind of establish right off the bat sort of which world we're living in. And so whenever we're dealing with Treasury stock, really the fundamental issue is this transaction that we're dealing with, is it a distribution or is it a contribution? So whenever we either retire or reissue Treasury shares, we have to first establish, is it a contribution or a distribution? And so in this case, again, you can put it in the chat or you can chime in. Does it seem like that this is a contribution to 49er Company, or if this is, or is this a distribution to the shareholders from 49er Company, given this reissue price of $15 per share, and given the original repurchase price of $7.50 and $11 per share. Which one is it? Is this a contribution or is this a distribution? So we have one student that says this is a contribution. We have a few that say distribution. So it is a mixture of the two. All right, definitely a mixture of the two. Just to kind of set it up a little bit. So if there's a contribution, again, a contribution to the company, that's a situation where at the end of the day, the 49er Company has more resources than they had before. And so there's going to be this additional paid-in capital treasury stock account. If it is a distribution, then at the end of the day, after all is said and done, the company has fewer resources than they had before because those resources have been distributed to the shareholders. And so somebody who said contribution, if you wouldn't mind chiming in, why do you think it's a contribution?
Oh, because they end up with more cash, right, at the end.
Yeah, exactly. Because at the end of the day, the company ends up with more cash because remember, they're receiving $15 per share when they had only paid either $7.50 or $11 per share. So they at the end of the day, they have more cash, they have more resources. And so the shareholders through this treasury stock transaction made a contribution to the company. And so as soon as you see that it is a contribution, we need to be looking for a credit to our additional paid-in capital treasury stock account. If it had been a distribution, then we would be making a distribution out of one of two sources. One, if there is any prior additional paid-in capital treasury stock, we distribute out of that account first. And then if there is none or not sufficient amounts, then we distribute out of retained earnings. So again, that's just setting up contribution versus distribution. And so the entry amount to the treasury stock account, again, the FIFO method says that we use the August 5th shares first. And so the total number of shares was 45. So we reissue 45 of those shares at $7.50 a share. And then, of course, because there's 75 shares total, we also need to reissue 30 shares from the October 16th transaction, which is $11 per share. So the total entry for our treasury stock account is $668. And of course, treasury stock is a contra equity account. And so its normal balance is a debit. So when we're reducing the treasury stock account, that's going to be credit to our treasury stock account. And again, now we notice that the amount of cash that we receive is greater than the credit to the treasury stock account. That's consistent with this idea of a contribution. And so the additional amount above the treasury stock cost, that's how we measure the contribution. So APIC treasury stock then is a plug for $457. And that $457 then is that additional paid-in capital or additional contribution that was made. Any questions on that one? Okay. So for the next problem, at the end of the day, we had several things that happened. So we had a company had shares issued and outstanding. They issue some additional shares and then make a repurchase. But the most important thing is this last piece, which says that on October 1st, 2021, 49er Company declares and pays a 65-cent per share cash dividend. And so we need to provide that journal. Now, the nice thing is with this problem is that the date of declaration and the date of payment are exactly the same. So there's no delay. Now, in the example in the notes, there were three dates. There was there's the date of declaration, there was the date of record, and then there's the date of payment. And so whenever there's three dates, then it's a little more complicated, and you can refer to the notes to look at that. I simplified this one. And so the declaration and the payment date are exactly the same. The challenge with this problem, though, is understanding how many shares there are, because we know that cash dividends are only paid on shares that are outstanding. So at the beginning of the year, there were 10,000, but of course, there were some transactions that changed the number of common shares outstanding. And we just need to make sure that we have the right number of shares on the date of the dividend. Let's see if I can find the line. There we go. And so, first of all, the number of shares, we started off with 10,000. we issue another 600 shares, so that takes us up to 10,600 shares. But then we repurchase 150 shares, which leaves us with 10,450 shares. And so the cash payment is only on those shares that are outstanding at 65 cents per share for a total cash payment of $6,793. So the cash payment is a credit, $6,793. Now, of course, because the date of payment and the date of declaration are exactly the same, we only have to worry about the debit to retained earnings, because we know anytime there is a dividend paid, it is a debit to retained earnings. And normally, if there was a delay, you'd have a common stock dividend payable, and then the payment was made, the common stock dividend payable would come off our books, and of course, then cash would be credited at that time. But in this case, we all wrap it into one, so we don't have to worry about the payable. All right.
Are
All
the
right.
questions on the test going to
Yes.
be like that one? Or are they
So-
going to be more like the ones in the notes?
So it both would be fair game. You could have one where there's a delay. You could have one where it's all wrapped up in one. I don't remember every test question, but I could see myself asking it either way.
Okay, thank you.
Uh-huh. All right. So on June 1st, 2021, 49er Company reissues 200 shares of Treasury stock for $10 per share. The shares had been purchased at $14 per share in the previous year, and the balance in its additional paid-in capital Treasury stock account is $550. The shares were originally issued for $12. Provide the June 1st, 2021 journal entry. So we're only worried about the reissuance here. And so the first question we have is just like the 2 questions ago, is we need to determine whether we're in a situation where this is a distribution or whether this is a contribution. So again, in the chat, if you can kind of type in whether you think this is a distribution or a contribution. So pretty consistent on distribution so far. You can tell who the efficient people are. Crawford. He's like, D, got it. All right. Yes, it is a distribution. Now, somebody who said distribution, if you wouldn't mind explaining why it's a distribution, that'd be great.
Because they're selling them for less than they bought them.
Yes. So and I just use slightly different words. They're reissuing them for more than what they paid to purchase them. Now, I want to be very clear, though. The relevant number is the $14 purchase price. This $12 issue price is actually irrelevant to this transaction. So we have a cost of $14 and we have a reissuance price of $10 per share. But exactly right, that's a distribution, because what's happened is the shareholders received $14 per share but only paid 10. And so there is a $4 per share distribution. And so again, let's see if I can find, so this is a distribution. So as far as the journal entry then itself, the first calculation is fairly easy, which is the cash that we receive. We receive $10 per share for all 200 shares. And so we're going to be debiting our cash $2,000. The next calculation we're going to do is the Treasury stock calculation. Again, the purchase price of $14 per share is the most relevant amount. And so that $14 per share times 200 shares is $2,800. And so we're going to credit our Treasury stock $2,800. Then again, because this is a distribution, the primary source of the distribution is the additional paid-in capital Treasury stock account. And so that's the first place that we go. The additional paid-in capital Treasury stock account can be debited for only up to $550 because that's the balance in the account. So that's where we go first. But of course, the total distribution is actually $800. And so the remaining amount needs to come out of retained earnings. And so a retained earnings account then would be debited for the remaining $250. So again, that's the process. Distribution versus contributions first. If you get the fact that it's a distribution, then you have to say, well, do I have any APIC Treasury stock? If I do, then I distribute out of that account first. Once I exhaust that account, then any remaining distribution would come out of retained earnings. If there was no APIC treasury stock, then the entire distribution would come out of retained earnings. Again, that was a little more complicated, but hopefully it's not too bad. Any questions on that one before we move on to the next one? Okay. 49er Company holds 450 shares of its common stock in its treasury. Each share was purchased at $10 per share, originally issued for $5 per share. They do have an APIC treasury stock account balance. And the key here is it says they retire all 450 of these no par shares. So this is a share retirement. And so there's no reissue price. And so now we have to think about, okay, what are the relative, what are the most important, what are the relevant share prices? And of course, I hope it makes sense that the purchase price of $10 per share is relevant. And given that there's only one other price, the issue price is the other half of this transaction that's important. And so whenever there's a retirement, you compare the purchase price to the original issue price. And that's what you use to determine whether there is a contribution or whether there is a distribution. And so given those two prices, in this case, again, in the chat, do we have a distribution or do we have a contribution? So a little slower to respond. So pretty consistent that this is a distribution and we have one contribution. So ironically, you guys I don't think can see it. I have two direct messages to me that said contribution. The ones that are to everyone says distribution. And those who are willing to publicly reveal are correct. It is a distribution. And somebody who is comfortable saying, why is it a distribution?
Because they purchased at $10 a share and they were issued at $5, so you're getting like $5 more per share than
Yes.
when you issued it.
Exactly. So when you say you, just because there could be two yous, there could be the company and there could be the shareholders. When you say you are getting more money per share, which you do you mean?
The company or the shareholder? I don't know.
Fair enough. All right. Somebody want to help out?
The shareholders are getting more money than it's a distribution.
Exactly. Yeah. So the shareholders are getting an extra $5 per share compared to what they originally bought the shares for. So at the issuance, they paid $5. Now at the repurchase, they got $10. So the shareholders got $5 per share extra. So the company distributed an extra $5 to these 450 shareholders. Now, obviously, there's probably some delay in there, but as a group, the shareholders have more resources than they had before, and the company has less resources. So this is a distribution. All right. So given this is a distribution, again, we're looking for a distribution out of APIC treasury stock first, and then a distribution out of retained earnings if APIC treasury stock is not sufficient. Let's see here. All right, so the first calculation is we do need to take the common stock off of our books whenever there's a retirement. Instead of crediting cash, instead of debiting cash, we debit common stock. And so the amount that the common stock was issued for was $5 per share. And again, it's no par value, so we don't have to worry about APIC common stock. And so $5 per share times 450 shares, that gives us the credit for the common stock account. The debit for the common stock account. And then for the treasury stock account, I think it's right in here. There it is. The treasury stock then would be credited at $10 per share applied to the 450 shares, which means the total credit for treasury stock is $4,500. And again, the distribution first comes out of APIC treasury stock, and the maximum amount of the APIC treasury stock is $220 because that is the balance in the account that was given in the problem. APIC treasury stock, $220. And then the remaining amount comes out of retained earnings, and that is a plug for $2,030. Again, if there had been no APIC treasury stock, then retained earnings would have been debited for $2,250 for the full distribution amount. Okay. Last question. On November 1st, 2020, 49er Company has 100,000 common shares issued and outstanding. It has a stock price of $20 per share. On this date, 49er Company declares and issues a 10% stock dividend. The common stock has no par value. Provide the November 1st, 2020 journal entry. So again, they declare and issue the stock all on the same date. And so we don't have to worry about that, common stock dividend distributable account because it all happens at once. The example in the lecture guide does have a two-step, and so you can see what to do in that case. So the biggest thing here is determining whether it is a small stock dividend or whether it is a large stock dividend. And so again, that range is, up to 20 to 25% and less is considered a small stock dividend. And as soon as you get to that 40% or above, you're looking more at the large stock dividend. And so this is at 10%, this is definitely a small stock dividend. And really the difference is with a small stock dividend, you account for the transaction using the share price. With a large stock dividend, you use the par value. All right, so since this is a small stock dividend, the share price is the relevant amount. And so when we're talking about how to value the transaction, if I can find it, where did I put it? Is it there? Sorry, I'm not liking what I only did 2 lines. No, that can't be right. There it is. I couldn't find it. All right. Given that the share price is what's relevant here, we figure out, well, how many shares are being issued? Well, 10% of 100,000. And then we apply the market price to those shares so that the way we're going to value these shares that are being issued, we're going to value them at $200,000. Now, again, in the live lecture, I described how this approach is somewhat arbitrary. There's really no meaning behind it other than it constrains the amount of stock dividends that you can declare. Because obviously you could exhaust your retained earnings pretty quickly with this type of transaction. And so then the two sides of the transaction hopefully are pretty straightforward. The common stock, again, we're assigning this $200,000 to the common stock, and also that is the amount that we're going to debit our retained earnings for. So this is acting like a distribution of shares, but in reality, of course, no one's better off because you just have more shares that are now worth slightly less than the market. And so there's no economic meaning behind this, but of course we do need to account for it. Okay. All right. Well, that's all the problems I have. So we actually went pretty fast. Wow, 32 minutes. So there's definitely time if you have any questions. I'd be glad to answer any questions about the problems or about anything else. So in this case, so Mackenzie asked why we use common stock rather than common stock dividend distributable, and the key is because it's declared and issued on the same date. So basically, if you could do this in 2 transactions. You'd have retained earnings, common stock dividend distributable, and then immediately take off the common stock dividend distributable and credit common stock. That would be okay. But at the end of the day, this is on November 1st. This is what happened. So I just kind of put everything into one step. Any other questions about this or any of the other problems or anything else? So someone asked if you have to know how to do LIFO or weighted average. So LIFO, yes. Weighted average, no. For Treasury stock. So for handling Treasury stock, I'm going to do LIFO or FIFO. I will not do weighted average. Although weighted average is an acceptable method, but the point of this class isn't for you to calculate a weighted average. It's for you to understand, that there are differences in how to apply basic ones. Yep. Any other questions? Well, all right, everybody. All right, so sorry, somebody asked another question. Is it always the case where a company declares and issues on the same day? No, actually, in most cases, it's not. Most of the time, there's, a month or more delay between the time that it's declared and when it's actually issued or when the cash dividend is paid. I just consolidated it into a simpler problem just for this example. So someone asks, is our grade in Canvas correct? It should be. Yes. Your grade in Canvas should be correct. It reflects the grade line at 89.5, 79.5, everything else. Now, the one thing I will kind of caution you on is your attendance grade right now is significantly overweighted, because obviously there's only 150 total points, the $100 test, or $100 point test, and the $50 wow, I got dollars on the mind here, and 50 point attendance grade. So out of the 150, a third is attendance, but by the end of the semester, it's going to be 50 out of 850. So it's not going to be as heavily weighted. So just, I would caution you on reading too. I would really focus more on what your test grade was. Any other questions? Well, all right, everyone. Thank you so much for your time. And we will do this again a week from Thursday. So I think a week from Thursday is our next session. And I'll see you all then. Hopefully these are helpful. If you have any questions in the meantime, feel free to email me. And otherwise, have a great week. Enjoy these next few days of sunshine. Take care.